What's going on, guys? We are back with another 3 stocks to buy video, but this time we're heading across the pond to look at some US stocks. Now, the first time I posted this video was back in May, and that was covering UK stocks, and those picks have performed pretty decently since then, outperforming the market. Now, I'm a long-term investor, so I don't particularly care what happens in the short term, but I think people are probably interested anyway. So we'll have a look at what those returns have been so far, and then we'll get onto the US stocks. So the first UK stock that I recommended back in May was S4 Capital, and it's been on a decent run, returning just over 17% in those 2 months. The second stock that I recommended was Auto Trader, and that's also been on a decent run, now up 14% in the 2 months since. And then finally, we've got Severfield, which has done pretty much nothing at all in that same time frame, which has moved up only 1.5%. Now, those 3 stocks give an average return of 11% compared with the FTSE 100 of just 3.5% and the S&P 500 of just 4.5%. So in the short term, the stocks appear to be doing well. But honestly, don't pay too much attention to how much the stock price moves in 2 months' time. For me to say that I've outperformed the market by 173% in 2 months is just nonsense. It doesn't mean anything. If I outperform the market over 3, 4, or 5 years, then I'll start to take some credit for it. But honestly, looking over 2 months is absolutely pointless. I've really only put this in here just because I think people might be interested. Anyway, for today's video, I've got 3 US stocks that I think are going to outperform the market long term, and 2 of these I've never mentioned on the channel before. Right, so the first company that I think is going to outperform the market long term is Dropbox. Now, this is a stock that has literally done nothing in the 3 years since its IPO, so it's gained just 7.5% in that time. But now I think the market is starting to realize that this isn't a company whose market share is just being gobbled up by some of the bigger players in the cloud storage space. So in the last 10 months or so, this stock is up 68%, and I still think that it's severely undervalued. Before we move over to my very basic valuation of the company, which shows just how undervalued it is, I wanted us to look at their Q1 2021 results, which shows just how well this company is still continuing to grow. All right, so they posted first quarter revenue $512 million, and that's up 12% year over year. Their free cash flow of $109 million is something like 22% of revenue. Now that is incredible. GAAP and non-GAAP operating income of $42.5 and $148.5 million, up 59% and 103% year over year. So this is a company that is literally only just becoming profitable, but now we're starting to see the fruits of their labor. So not only are they now profitable, they've also been making some really good acquisitions to help the company grow. So they welcomed DocSend to the team, and that just complements HelloSign and also Dropbox as a whole really, really well. Now, one of the main criticisms that people have often had about Dropbox is that once the big players get involved, they're going to lose market share and they're not going to be able to compete. And here's why that's just not true. So we can see here that paying users ended at 15.83 million compared with 14.59 million for the same period last year. So they're growing their user base. But not only are they growing their user base, average revenue per paying user was $132 compared with $126 for the same period last year. So they're growing their user base and they're also charging more for their services. That to me isn't indicative of a company that's losing its market share and is struggling in this space. Not only that, their balance sheet is really good as well. They've got cash and cash equivalents and short-term investments at $2 billion. Now this is a company that has a market cap of $11 billion. So you're getting almost 20% in cash straight away. Now they are carrying some debt as well, but I'm okay with that because their capital allocation is really, really good. And that's been evidenced through the growth at the companies. Right, now here's my very basic valuation of the company. Now, if anybody wants me to do a more in-depth valuation like my other videos, I'm more than happy to do that, but I want to try and keep this video as short as possible. Okay, so down here we can see the free cash flow that Dropbox was able to generate in 2020, and that represented 26% of their revenue, which is absolutely fantastic. And actually, before we get onto the growth, I just want to show you how well they've been growing their free cash flow. So if we just calculate what their free cash flow growth has been year on year, so in 2017, they grew their free cash flow by 136%. In 2018, it was 18%, 2019, 9%, and in 2020, it was 26%. Now, if we look at analyst estimates, we can see that they're expecting earnings growth of 17% per year for the next 5 years. Now, I'm going to apply a 15% compounded annual growth rate to their free cash flows, which honestly I think is conservative. So you can see here that actually their free cash flows grow a lot quicker than their earnings do. So I think that applying a 15% compounded annual growth rate for the next 5 years is very, very conservative. But let's just use it anyway and see what the valuation comes out with. And then in 5 years' time, I'm forecasting that the market is going to want a free cash flow yield of 3%. Now that's quite conservative because if we see here, the trailing free cash flow yield for the S&P 500 fell from 2% at the end of 2019 to 1.2% as at the end of March. That means that right now the market is willing to pay 83 times free cash flow, whereas I'm applying a 3% free cash flow yield, which means that the market will be willing to pay 33 times free cash flow out in 5 years' time. Using those figures, I get a price target of $79 in 5 years' time, which is a compounded annual growth rate of 21%, which I don't think you can complain about at all. Okay, so the second company on the list is a company called Fiserv. Now, this is a company that you may not have heard of before, but you've almost certainly used their services. As a matter of fact, you probably use their services every single day without even knowing it. So Fiserv is a financial technology services company. We can see from their investor relations page here that they aspire to move money and information in a way that moves the world. As a global leader in payments and financial technology, the company helps clients achieve best-in-class results through a commitment to innovation and excellence in areas including account processing and digital banking solutions, card issuer processing and network services, payments, e-commerce, merchant acquiring and processing, and the Clover cloud-based point of solution. Effectively, anything financial technology services related, they provide it. And when I say that, I really mean it. So if we look at who they serve financial institutions such as banks and credit unions. They serve merchants, so effectively retailers. They sell corporates as well, such as healthcare, insurance, telecommunications. They serve the government, and then they also serve individual consumers as well. Now, in a world where physical cash is becoming more and more obsolete, the fintech industry is growing massively year over year, and Fiserv are well positioned to benefit from that growth as they're well established in the industry and they've been around for more than 30 years. And Fiserv are making sure that they make the right acquisitions to make sure that they can keep up with the growth of the industry. So we can see here that Fiserv is now the owner of First Data since 2019, and by extension, the Clover brand and products, meaning Fiserv is directly competing with Square and Shopify in point-of-sale payment terminals for small businesses. Now, it's absolutely clear that the market is expecting massive growth in the point-of-sale for small businesses industry. You only have to look at the PEs of Shopify, for example, which is 115, and the PE ratio of Square, which is 395. So the market is expecting massive growth in the industries that they serve. I don't think that the market has properly recognised yet the synergies that Fiserv can get from the First Data acquisition. So we can see here that First Data has 6 million merchants, the largest in the payments industry. The company handles 45% of all US credit and debit transactions, including handling prepaid gift card processing for many US brands such as Starbucks. It processes around 2,800 transactions per second and $2.2 trillion in card transactions annually, with an 80% market share in gas and groceries back in 2014. Now, just before we get onto my very basic valuation of the company, if we look at their most recent quarterly results, you can see adjusted revenue of $3.56 billion, up 2%. Now, 2% is obviously not impressive at all, but you do have to remember that their point of sale, so their payment processing for that side of the business, will be a little bit lower than what it will be going forward, just because a lot of businesses, a lot of industries still haven't fully opened up yet. I think once we do see that open up, Fiserv will benefit from that greatly. Far more impressive than that, though, is that their adjusted earnings per share of $1.17 is up 18%, so that's massive. And just remember that number, because in my valuation, I'm going to use a figure similar to that going forward for the next 5 years. But one of the most impressive metrics for me for Fiserv is their free cash flow conversion. So we can see here that they have free cash flow conversion of 103%. So free cash flow conversion measures how much net income a company makes and how much of that actually flows through the company as free cash flow. And the higher the free cash flow conversion, the higher the quality of the earnings that the company generates. And Fiserv typically achieve a free cash flow conversion of anywhere between 100 and 110%. So their quality of earnings are very, very good. And I love a company that is able to generate really strong free cash flows. And then coming back to the point I was making around synergies from their First Data acquisition, we can see here that they actioned $265 million to date in merger revenue synergies and $1.1 billion to date in merger cost synergies. So that's very good for the business, and it will make them more profitable in the long term. Not only that, they're also repurchasing their shares. So they repurchased 5.2 million shares in the quarter for $612 million. And that goes to show how confident management are in the current share price of the business. I'm just flicking over to my valuation model. They've got a current share price of $109. They've got 662 million shares outstanding. Gives them a current market cap of just over $72 billion. Now, they are carrying quite a bit of debt, so their enterprise value is $94 billion. And a lot of that debt came from the First Data acquisition, so it is going to take some time for us to see the benefits of that. But with that being said, their free cash flow generation is so strong that they can easily service their debt, and eventually they'll just start to pay it down over time. Now, just before we come on to the enterprise value to EBITDA multiples, I just want us to look at the 5-year compounded annual growth rate, which I've put in 16%. So I've grew their EBITDA by 16% year over year. And in 2025, that means that we'll have EBITDA of $10.5 billion. Now, in terms of where I got that 16% compounded annual growth rate from, you'll remember from their first quarterly results, they achieved earnings growth of 18%. If we just flick over to Zacks and we look at analysts' estimates, in year 1, they're expecting 23%, and in year 2, they're expecting 17%. And then again, if we look at the 5-year compounded annual growth rate on Yahoo Finance, analysts are expecting growth of 18% per year. So I've gone with 16% just to try and remain a little bit more prudent. So now we have an expected EBITDA in 2025 of just under $10.7 billion. And in order to arrive at a valuation, we need to apply an enterprise value to EBITDA multiple to that. So the current enterprise value to EBITDA multiple is 18. And actually, I think that just goes to show how undervalued this company actually is. So if we look at the industry averages, we can see here that the median enterprise value to EBITDA steadily rose in 2020 with a slight drop in the fourth quarter. The multiple nearly doubled from the previous year, going from 21 in Q3 2019 to 42 in Q3 2020. Now, I don't think that it's fair to apply 42 because effectively there are a lot of companies that are bumping up that average. So we look at Square and we look at other companies in the fintech services industry. And effectively, because they're expected to grow so quickly, they have these ridiculously high enterprise value to EBITDA multiples. Now, even though that 42 is a median value and not a mean, I still don't think it's fair to apply a multiple of 42 to a business like Fiserv. But I think that 20 is probably reasonable. If we look across to Visa, for example, they're attracting an enterprise value to EBITDA multiple of 36. So that's double what Fiserv are currently commanding at the moment. Now, again, I don't think it would be fair to apply a enterprise value to EBITDA multiple of 36 to Fiserv. But I think it's probably fair to say that in 5 years' time, Fiserv probably should be trading at least a multiple of 20. So if Fiserv are able to grow their earnings by 16% per year, which again I think is conservative when we look at analysts' estimates, and they do attract an enterprise value to EBITDA multiple of 20, their price target in 5 years' time will be $323, which is an annual return of 24%, which again would be very, very good. So looking at these numbers alone, in my view, this is a company that is very much undervalued. And I think that once the synergies start to come into play with the first data acquisition, we'll start to see that the market realizes that and applies a greater enterprise value to EBITDA multiple, as well as their earnings growing on top of that. And I think that 24% per year for the next 5 years as your compounded annual growth rate on your investment is very, very possible. And then finally, I couldn't possibly do this video without talking about Alibaba. So some of you will know I've already done a couple of videos on Alibaba, and I'll put one of those there or there, whichever one it will be. But effectively, this is a company that is absolutely huge and its growth is showing no signs of slowing down. And I think that we can expect that to be continuing in the future. And I think that the value of this company is so low in comparison to what it should be, that it just makes sense for people to have this in their portfolio after you've done your own due diligence, of course. If we just quickly look to their latest quarter results, their revenue is up 64% compared with the same quarter last year. Their revenue for the entire year was up 41%. Their free cash flow is up 32%. Their earnings haven't grown much, but that's because they reinvest so much into the business. So we can see from this press release dated the 8th of June, Alibaba Cloud invests $1 billion to support startups, developers, and new talents in Asia Pacific. So Alibaba are a business that are constantly reinvesting into the business in order to allow the company to grow. And just to give you an idea of just how much Alibaba does reinvest into its business, if we look at their product development expenses, so effectively research and development, they had expenses of $9 billion. Which is around 9% of their revenue. And that is absolutely massive. That's sort of on par with how much Amazon is reinvesting into their business. And I personally think that their cloud business is their biggest opportunity that they have. So cloud businesses typically generate really high gross margins and net margins as well. And also, I think that the growth in this industry is going to be huge over the next 10 to 15 years. So we can see here that the post-pandemic world is facing a massive opportunity for industrial digitization. Cloud infrastructure will eventually replace IT infrastructure, empowering enterprises to achieve digital transformation. So in my eyes, Alibaba are clearly focusing on the right industries in order to maximize their earnings in the long term. Now, if we just flick over to my valuation model for the business, now this is a discounted cash flow and earnings multiple model. It's far more in depth than the others, and so I'm not going to dive into all of the numbers. If you do want to see me talk about it in depth, you can go check out one of the other videos that I've done on it. But effectively, if we expect revenue to grow at 20% for the next 5 years, which is absolutely ridiculous. I think it's clear that they are going to grow faster than that. They've just achieved 41% revenue growth in the last year. So I think that 20% is very, very conservative for the next 5 years. And then 6 to 10 year revenue growth of just 12%. Again, that is ridiculously conservative, but I'm just doing it to show you how undervalued this company is. And then we've got terminal growth of 2%, which again is very low considering just how much China is growing and how much that the middle class in China is growing as well. We arrive at an average estimated intrinsic value for the company today at $297. And you can currently buy the company for around $217. So that provides a margin of safety of 37%, which is ridiculously high. It's very good for a company of this size. Anyway, guys, that is all for today. I hope you've enjoyed the video. As always, you have to do your own due diligence before making any investment decision. I am not a financial advisor, and this is not financial advice and should not be construed as such. But it's just a way of me putting different stocks on your watch list so that you can go and dig into them deeper and then decide whether you want to make an investment decision or not. Anyway, guys, thank you again for watching, and until next time, see you later.